rely on fund managers to look after their assets or look after their pensions. And no wonder when you open an account with a brokerage, maybe a Hargreaves Lansdowne or whoever, they're thrust at you, or they're thrust at you on adverts or on billboards everywhere, because, of course, there's a lot of money to be made by fund managers having you invest through them into the stock market. But there's a problem. There's a problem which I've highlighted in my Financial Times columns over 20 years ago. There's a problem which has been highlighted by research, Nobel Prize winning research. I'm going to take you through some of that. And that is funds consistently underperform. And the solution, I'm afraid, is not, well, let's pick one which won't. The fact of the matter is, the chances of you doing that is highly unlikely. So, what should be done? Well, let's first look at the problem before we look at any kind of solution. One of the problems is this, and I'm going to walk you through it. Of course, it's been a difficult few years for UK fund managers. We could say that at any time in history. Between the Woodford Equity Income Fund problem, let alone other fund managers, and COVID-19, so-called star fund managers, which always promise so much, especially because the media loves a darling, they only end up disappointing. And it's not just Woodford, it's been many others. Investors looking to find the right home for their pension, SIP, or ISA therefore have a problem. They lose money due to either the fund manager's underperformance, or they can choose to learn about investing themselves and pick individual stocks themselves instead. So let's look at the problem. Like I said, Standard & Poor's global indices measures or has an active fund manager scorecard, and it measures how fund managers perform against Standard & Poor's own index. And of course, Standard & Poor's do this because, as you might know, the S&P, Standard & Poor's 500, is an index. And of course, they want you to track an index. And we'll come to whether or not that's a good idea a little bit later on. But the problem arises that their data shows that fund managers are not as good as the index. In 2018, for instance, they reported that almost 3 out of every 4 active fund managers had underperformed against the market benchmark, the S&P. This is in the case of the US. And it's no different for the UK indices over any period of time. More recently, in the tumultuous conditions we find ourselves in, which have often been touted as ideal for fund managers, such a difficult time in the market. And yet, what happens? Well, many again continue to underperform an index which hits an all-time high. Okay, so what's to be done? Over the last 3 years, Invesco UK Equity High Income Fund, sounds very good, high income, had for 3 years underperformance of 21%. Over 3 years, underperforming by 21%. You would have earned 21% more by just tracking the benchmark index for that fund than have put your money in the Invesco UK Equity High Income Fund. And I'm not trying to compare it to the S&P or to compare oranges with apples. I'm talking if you tracked the index it tracks. 2 other funds of similar size with a lousy performance were JP Morgan's US Equity Income Fund, and I'm not cherry picking bad ones, or rather bad apple picking. This is research from S&P. JP Morgan's US Equity Income Fund, which holds over £3.2 billion. £3.2 billion. Think of it. We're not just talking, oh, this doesn't affect many people. This affects probably you and you don't realize it. Let's say you work at the BBC or the NHS. You've got to ask them, wait a minute, my pension contributions are going somewhere. Are they going into these funds? Because you never ask that. You think, oh, I've got a great pension. And actually, are they going to these funds which are underperforming? Could it have done better? Doesn't mean you pull a pension. Pensions are great as a concept, tax-free, all the rest of it, or tax mitigated. But where's the money going? So it had underperformed by around 27%. Okay, it had underperformed by around 27%. This pattern continues throughout the investment fund industry, as S&P found. Witten Chief Executive Andrew Bell has recently apologized to investors after what he termed a lamentable performance during the COVID crisis. They were wrong footed, they were slow, and as the market went to all time highs, they couldn't keep up. They got it wrong. And these are the experts. They trailed the market by a shocking 12% in the case of Witten, which Bell explained was due to inactivity in cutting the fund's exposure to UK stocks affected during the pandemic and the resulting lockdowns. They were slower than perhaps you would have been because you care more about your money than somebody who's going to get fees either way. They were caught in the headlines, and we shouldn't be surprised. Headlights, we shouldn't be surprised. They live in a bubble. In their world, maybe things were great. They were fine. Hey, you got a city job. Maybe they can't relate to what the man on the street in Leeds is experiencing, or the woman on the street. The fund had performed strongly in 2019. As often happens, the good performers in a particular year do not persist in their outperformance. But that progress was wiped out, not surprisingly, by dithering for too long during the crisis, eventually leading to losses. 91, another asset manager, the self-styled sustainable active investors have admitted that about a third of its funds are underperforming against the market. A third. 10%, 5% underperforming, I'd expect. I mean, these are supposedly experts who get paid whether the market goes up or down. They're underperforming against their own benchmarks, not against a really difficult cherry-picked one, but against their own, okay? That they choose. They even choose their own goalposts and can't score the goals. With a total value of £2 billion, 3 of their funds had all suffered low returns for investors. £2 billion. So you can ask yourself, my pension, where I'm working, are they giving it to 91 to invest? Or other similar fund managers? The cautious managed fund, should be safe, £1.2 billion total fund is down about 11% over 3 years. Whilst, as we know, so many of the world's markets are hitting all-time highs, so the US markets are hitting all-time highs, and they're trailing the industry average by around 17%. They can't even compete with their peers, let alone their own benchmarks. So how low a bar are we supposed to set for fund managers? And this isn't a recent problem. Year after year, decade after decade, this has been shown to be the case. Whilst things weren't looking too good for two of its other funds, the UK Special Situations, again, it sounds great, no? It's Special Situations. That's why I'm paying the fund manager money for special situations so they can find them because they'll find things I can't. Well, not so much. You would have done better tracking an index or picking them yourself, probably. And the UK total returns have returned a staggering minus 23%. UK total returns, well behind the market average of 3%. And 3% isn't bloody great either. Slightly more than a bank account. Okay, so what are we left with? Well, for those who invest their pensions in index funds, 2020 was a bad year. Yeah, so index funds might not be the answer before you think, he's just going to push us towards index funds. Actually, I want you to be more empowered in your own know-how. The FTSE 100 fell by around 14.3% in 2020, which was its worst year since the global financial crisis. While some of these problems were due to Brexit, of course, and a larger market recession, these mitigating circumstances will be of scant consolation to anyone who's lost a large chunk of their retirement fund, because in 2020, some of the major markets in the world hit all-time highs. I know my holdings in Microsoft did. My holdings in Apple, Amazon did. Well, you might say, well, that's easy. That's just tech, and that's just this year. Well, we'll talk about other stocks which aren't tech in a second. This exposure, of course, is the long-stated issue with index funds and underlines the importance of diversifying into stocks beyond just index tracking and beyond fund managers. There's another problem. Sorry to bring all the problems onto you. Huge fees. One of the most striking aspects of UK funds' chronic underperformance is the high fees. So they not just underperform, they then charge you for the pleasure of kicking you in the teeth. 17 significant funds lag behind the market over the previous 3 years, with funds like Invesco. So I'm not just picking minor companies. These are household names. Invesco's UK Equity Fund and high income funds drawing over £70 million in fees whilst underperforming. That's just wrong. They don't need the money. Jupiter Asset Management also has 3 funds on the list of companies charging exorbitant fees for terrible returns. High fees, highest fees in the industry, lowest returns. Who matches those? Jupiter Asset Management Income Trust, absolute return, and its UK growth. For God's sake, it says growth in the title and high fees and underperformance. That should be criminal. That really should be criminal. For UK investors looking to grow their pension pot, none of this is, of course, good news. UK funds operate in a very efficient marketplace where small margins decide who the occasional victor is. It is for this reason I think UK investors should be looking at ripping out the fees by learning how to pick their own portfolio. We'll come to that in a second. And stop relying on purely fund managers to do all the work for them. So how do you start? Well, first of all, you might want to just learn a little bit about, well, what does research show impact share price performance over, let's say, a 12-month period? After all, you don't want to be a trader trading in and out every day. Over a 12-month period, what tends to impact it? And research suggests, yes, the value of a company. In other words, its share price relative to the profits it generates, profitability growth, sales growth, words you can all understand, the dividends it pays, the cash flow it generates, its consistency of outperforming the market, and the volatility and the movement of the share price. All of these factors impact its future performance. Research proves it. So what if we could pick stocks along that line? We created a completely free tool based on, you see all my books over my shoulder, based on all of that, completely free, converted the books into videos and articles, totally free, to educate 1 million people on how to invest better and for themselves. So don't just rely on a journalist with a clickbait headline. It's not his job to pick stocks, so why would you want to entrust your future to them? Okay, instead, have a look at our free materials on campaignfor1million.com. It's totally free, tons of it. And the reason for doing it for free is nobody reads books anymore. They don't read my books anymore. I don't think they read a lot of books generally anymore. And these are Financial Times international bestsellers. And I thought it's worth converting it into videos to just, educate people. For those who don't like reading or watching videos, we've got a free Telegram channel on there as well, which will share research with you like I just have, 3 or 4 times a day, just seep into you what happens in the market so you become more financially literate. If not you, your children at least do. Hope you'll find that useful and you understand now the context of why it's so important